Good evening and welcome to today's episode of Grant Thornton Bharat's flagship webinar series, Evolving Judicial Landscape of Direct Taxes. This series has been designed to keep tax professionals and business leaders abreast of significant judicial developments shaping India's direct tax framework. I am Riaz Thingna, partner at Grant Thornton Bharat, specializing in tax advisory and regulatory services across both domestic and international tax matters. We are really looking forward to an engaging and insightful session, and your participation will make the session more enriching for everyone. Let me introduce you to the exceptional panel of experts we have today. We have Mr. Pramod Kumar, who has been Vice President, Income Tax Appellate Tribunal. During his tenure, he's authored 15,000 judgments on direct tax. He's also been a director of International Association of Tax Judges. He has around 4 decades of professional experience in handling direct and international direct tax matters, including 23 years at the ITAT. Welcome, sir. We also have Ms. Richa Soni, who leads the National Tax Office for GT Bharat. She comes with over 30 years of experience in handling complex tax and regulatory matters and has been actively involved in monitoring, analyzing key tax policy developments, and making representations to the concerned authorities. She's also been the author of several thought leadership publications on policy developments. Welcome, Richa.
Thanks, Riaz.
Our next panelist is Mr. Amit Kumar. He has over 25 years of experience in consulting on international and corporate tax and regulatory matters. He specializes in advising clients on business and operational structures from a tax and regulatory perspective. He has also extensively advised inbound and outbound clients on tax efficient structures. He's also a regular speaker on tax and regulatory forums and has also been involved in representation before the tax appellate authorities. Welcome, Amit.
Thank you, Riaz.
So now, today, we'll be discussing 2 recent judicial pronouncements. First, the Delhi High Court's decision in CIT versus Ernst & Young US LLP, and the decision of the Bangalore Tribunal in Pramod Kumar Jain versus the CIT. Let us start with the Delhi High Court ruling. Now, taxation of cross-border secondment arrangements has emerged as one of the most contested areas of Indian international tax jurisprudence, centered on a seemingly simple question. When a foreign entity deputes employees to an Indian affiliate and receives a reimbursement of their salary cost without any markup, is that reimbursement taxable in India as fees for technical services, or is it merely a pass-through recovery of employee remuneration? Conventional analysis has largely focused on the treaty question, particularly whether secondment arrangement satisfies the make available requirement under Article 12 of India's tax treaties. The Delhi High Court has held that the reimbursements were taxable, finding that the foreign entity remained the real employer and the secondees transferred organizational knowledge, systems, and standards to the Indian entities. The Delhi High Court's decision is significant not merely because it ruled against the taxpayer, but because it potentially reshapes the tax treatment of cross-border secondment arrangements in India and revives several issues previously thought to be settled by the taxpayers and practitioners. So now, diving straight into the topic, Richa, could you please provide us with a broad understanding of the case? You're on mute, Richa.
Let's start with the facts of the case. Now, the taxpayer in this case was a US LLP and it seconded certain employees to its Indian group entities for a fixed tenure which was generally between 2 to 3 years. The key terms of the secondment arrangements were that the seconded employees, they were to work under the supervision and control of the Indian entity. They were accountable only to the Indian entity during the secondment period. The Indian entity was responsible for paying salaries and other costs of the seconded employees, but just for administrative convenience, these were to be paid by the US LLP and they would be cross charged to the Indian entities. And this was to be done on a no markup, a cost to cost basis. So the taxpayer here, they received the reimbursement of salary cost. The AO held that these payments were free for included services and it was approved by the DRP. The tribunal set aside the addition and then the matter traveled to the High Court. Next slide, please. So if we were to look at what were the key observations of the High Court on the critical elements of this arrangement, first let's talk about the substance of the secondment arrangement. Now here, the High Court, it drawed very heavily on the observations made by the Centrica decision, where it was held that characterization of a payment as reimbursement is not determinative of its taxability. You need to see the substance. The court here examined that in this particular case, there was a continued lien of the seconded employees with a foreign entity, and they would return to the foreign country after completion of the assignment here. They were assigned to the Indian entities for a fixed tenure, and therefore this secondment should rather be treated as a deputation rather than a permanent transfer or absorption of the employees by the Indian entities. The Indian entities, yes, they did have the right to terminate the assignment or the secondment. However, they could not terminate the employer-employee relationship as far as the secondees and the foreign entity was concerned. So in essence, the secondees retain their employment with the foreign entity and continue to receive benefits from the foreign entity throughout the secondment arrangement. On the next aspect, the observations of the court were that related on to the make available test. Now, here the court observed that the seconded employees came to India to ensure the application of the taxpayers' group policies, processes, and quality standards. And once such policies are imbibed or retained, the Indian entities can independently apply those policies without having recourse to the seconded employees again. This, as per the court, said that the make available test is met. The scope of services, it specifically said that they were to impart certain training. And since training involves transfer of knowledge, experience, skill, or know how, therefore, it supports the conclusion that the technical knowledge or skills are being made available to the Indian entity. So the conclusion then was that make available condition under the India-US DTA is met. On the next issue of reimbursements, what the court said was that once the arrangement is found to involve provision of services through the seconded employees, the reimbursement mechanism cannot change the character of the payment. And taxation of salary in the hands of the seconded employees, that also doesn't determine the taxability in the hands of the foreign entity. These are two separate issues. Finally, the court held, can we move to the last slide? It agreed with the findings of the AO and the DRP that these seconded employees, they had a lien on the taxpayer and the service rendered by such employees satisfied the make available requirements under the India-US DTA. The secondment reimbursement received by the taxpayer from the Indian entity were FTS and FIS under the Income Tax Act and the India-US DTA. Cost to cost nature of reimbursement and absence of markup does not alter the taxability of the receipt, where the substance of the arrangement indicated that there was a provision of technical consultancy services involved, which happened through the seconded employees. So the High Court had set aside the tribunal's order and held that the secondment, the amount that has been reimbursed is actually taxable as FIS. Back to you, Riya.
Thank you, Risha, for a very succinctly compiled summary. So moving on to you, Pramodji, there's a lot of noise around many principles emerging from this decision. Could you please give us your view on what this decision decides, what it does not decide, and what it needs to be decided in the context of secondment arrangements? You're on mute, sir.
I hope I'm audible now.
Yes, absolutely. Thank you.
Thank you so much. Riaz, the noise comes from reading this judgment as deciding much more than what it was asked to decide and what it actually decided. And when I say so, I may also add that a judgment is like a stage in a journey, not as a destination where you have all the answers. So here is a judgment which was dealing with a certain situation of a cost-to-cost recharge, and going by Centrica and by Centrica analysis. As a matter of fact, you will find in the text of the judgment, you would not find much of the analysis of the domestic law issues which are treated as covered by the Centrica decision. So going by the Centrica analysis, taking it a step further, and since the Centrica was not engaged with by the tribunal, not even dealing with the distinction between the facts of Centrica in this case, court proceeded to hold that here is a cost-to-cost reimbursement where the foreign entity has remained a real employer. The organizational knowledge, systems, standards passed on to Indian entities. It makes available, the make available test is satisfied on that fitting. And it took a strong exception to the tribunal not engaging with the Centrica decision. Now, so far as this decision is concerned, that is on this question, and it is seen as an extension of what Centrica decides and what was the law prevailing at the point of time when Centrica decision was rendered. Now, what it does not decide, and I think that's the most interesting part, three things, because if you're looking at the taxability part, treaties come much later. It is fourth gate probably. The first gate is whether it's an income at all or not, whether a reimbursement simpliciter can be said to be an income. And when you read the text of the judgment, you will find they have quoted from what Centrica decided, which in turn was depending on a ruling by the authority for advance ruling. They have not noted any argument to the contrary and proceeded to deal with this. Now, what does it say? It talks about the definition of income by way of fees from technical services. But when you look at the AT&S ruling, which was an authority for advance ruling decision given long back, I think 2005, around that time, that talks about the definition of fees for technical services. But then what is brought to text under section 917 is income by way of fees for technical services. So there is a gap between what AT&S ruling decided, which was followed in Centrica, or referred to in Centrica, and which has in turn come to this decision, and what is the definition part. You have to meet the income gate first and then go to income by way of fees for technical services. The distinction between income by way of FTS and FTS was left out in the AT&S decision, and that has carried on. Now, this becomes particularly relevant when you look at a subsequent decision of the Honorable Supreme Court in the case of AP Mauler, that is a 2017 judgment, the Honorable Justice Hickory, where he has said, and if I remember correctly, it's in last sentence of paragraph 11, that if it's a reimbursement simpliciter, it is not an income. Now, bear in mind the fact that section 9, which talks about deemed income, it does not convert something which is not an income into income. All it does is it changes the citers of an income. Now, if you see it in that perspective, you would realize that the law which was clarified or let down by the Honorable Supreme Court in AP Mauler's case is something which happened after Centrica decision, after AT&S ruling, and somehow it has not been engaged with, I would say, in this decision. So that is a question which is left to be decided. Now, the second thing it has not, I think, dealt with is what are the connotations of exclusion clauses, which are set out in explanation 2 to section 917. And these exclusion clauses deal with the income of the fact that the income of the recipient would be chargeable under the head salaries. Now, two questions emerge out of it. Number one, who is the recipient? Is the recipient of that money the same person who is the recipient of income? And there's a fine line of demarcation once again. And there are a whole lot of tribunal decisions and the whole decision of Honorable Bombay High Court in Wadhwan's case, where they have said that there's a difference in the recipient of income and recipient of payment. For example, if you give money to the bank for onward transmission, bank is not recipient. Recipient of income is the person for whom it is meant. So that line of demarcation between recipient of income and the recipient of money, that is something which has not been dealt with. And in the old stream of cases, you would find it having been explained at length. There's another aspect. When you talk about income which would be taxable, it is not income which is taxable. So it's a hypothesis. Hypothesis is if the income of the recipient is to be taxed under the head income from salaries, that gets out from the definition of income by way of fees for technical services. That is an aspect which is probably still to be engaged with, or it has not been dealt with in this respect. Then there's another part, and in all fairness, that part was even before the Honorable Delhi High Court that argument was taken. But somehow it has remained to be disposed of. That is with respect to the interplay between 192 and 195, where in Boeing decision they have said, the Honorable Delhi High Court has said that no, if you have deducted tax as fees for technical service as income from salary, you don't have to FTS. Sure. That part is left out.
Now we can come to that portion of 192 versus 195. I would definitely like to come back
so there are
to you.
Two more quick points. I think next gate is it is to be taxed on the gross basis and net basis. That is something left out, and that becomes particularly relevant because when you look at the taxability of the fees for technical services on net basis under 44DA, there's a very interesting change in the definition of common establishment right from 2002 onwards. And the treaty connotations are materially different from the connotations under the domestic law. And that is an aspect which is to be dealt with. And in Morgan Stanley case, the Honorable Supreme Court, even, they dealt with service fee being part of the treaty. And an interesting expression when they said, even a software fee could be part of fee. So that's an entirely different connotation. And of course, different streams of income can be taxed on the basis of treaties and the domestic law. That aspect was left out. And then the question of the make available test comes here. Because there was no occasion to deal with the differences in the facts of Centrica and the facts of this case. The Honorable Court proceeded on the basis that the facts are the same, and therefore it becomes income from fees for technical services under that also. So those are the areas which probably would still need to be dealt with, and these are the issues which have not been decided. Now, before I close this, there are two things I must say. First of all, it is so tempting to go to the gate of the treaty straight away because many would believe it's an open and shut case on the aspect of the treaty in the light of the law which has been laid down. There are different high courts which have talked about it. Secondly, in all fairness, this issue was taken up at the stage of the tribunal, and that is not an income at all. All those domestic law aspects were taken up, but these were not expressly dealt with. And what the High Court was dealing with was a decision on the call on the tribunal decision. So those issues did come up before in the course of the proceedings, but somehow these were not dealt with in the judgment. Now, what needs to be decided now? I think there's just two small points. First point is Centrica judgment. Because what did Centrica judgment decide? There are different, varying perceptions about it. It was a case in which the authority for advance ruling was in favor of the taxpayer, and the writ petition against the same was dismissed, and authority for advance ruling had said that there is no FTS. So whether the observations which they made with respect to the fees for technical services were in the context of taxability of fees for technical services or in the context of service permanent establishment, that's a point which needs to be dealt with. And the Karnataka High Court in Abbey Business Services has explained that. They have proceeded on the basis that these observations are confined to the context of the service fee, and therefore we don't have to, take it there. Secondly, on the Boeing decision interplay, that is left out. And finally, the limitations of source rule. How far would you take the source rule? That's a question which needs to be decided. Thank you.
Great. No, thank you. You've raised some very basic and very, very important issues which need to be addressed. And we should, again, come back to you, time permitting, on some of the aspects that you referred to. But in the meantime, coming to you, Richa, what about the distinction between the legal employer and the economic employer? And how has that been addressed by the court in this case?
So, Riaz, if we look at the real and economic concept, it has been discussed in detail in the OECD commentary on Article 15. And what it advocates is a substance-based analysis. And it talks about several factors that need to be considered. If I may just highlight few of them, who exercises control over the day-to-day working, who bears the risk, whether the employees' services are integrated with the host company's work, whether who economically bears the remuneration, who provides tool and infrastructure for work, and even to the extent who takes care of their holidays and the work timings. So there are several factors that they've laid out, and they've also mentioned that one single factor is not determinative. What you need to see is the ground realities, and then assess basis all these factors put together as to see what exactly is the role of a legal employer and who exactly is the real or the economic employer. Now, what we see in this decision, there is a lot of thrust which has been given, and I think the decision is that acts as the fulcrum for this decision, is that there is a lien on the employment, the fact that they are going back to the parent company again, and the fact that the Indian company, though it can terminate the employment here in India, it cannot terminate the employer-employee relationship at the US LLP level. So the greatest weightages have been assigned to these. So the question which comes up is that in backdrop of all the discussions at the OECD and which are generally accepted globally, what should be the weightages which are assigned to different factors? Are these two only factors? Then they are determinative of the real and economic employer, because here we are just talking about then moving back to the legal employer or the continuity employment approach rather than the classic OECD economic employer approach. So I believe there needs to be a further discussion on what weightages to assign to which factor, and whether all these factors put together need to be evaluated in more depth rather than emphasizing only just on two pieces.
Extremely important issues that you raised there. But as a follow-up question, Pramodji also referred to reimbursement and net profit taxation briefly. But what is your perspective on what the court has held on cost reimbursements? Does this have very wide ramifications? That is important.
Absolutely. I think the observations of the court on cost-to-cost reimbursement, and where I mentioned earlier also, they draw very heavily from Centrica. They should not necessarily overturn the long-standing principles that genuine reimbursement with no income element is not taxable. As Pramodji also mentioned, there is the AP Moeller case. Then you have G India, which support the proposition that a pure reimbursement at cost with no profit element, there is no taxable income and no tax withholding. Now here, if you were to look at this particular decision, when it talked about this concept of reimbursement, already a decision had been made that this was actually a service contract. So I think we need to look at the observation made in context of reimbursement with this backdrop, that the decision that the employees were providing services to the Indian entity was already decided, and then they moved on to here. Now, in that context, when this discussion came up, it became more like a markup issue. Whether there is an absence of profit or a pricing question. This is how perhaps the court has dealt with it, which in effect, in such situation, also brings to light the transfer pricing angle in a related party transaction. So, to my mind, this it does not have any ramification on a universal level, where you would still rely on the other decisions to say that cost to cost reimbursement, there may not be an income element and the withholding aspect, but it's a very fact specific case. So it has to be read in context with which it was rendered.
Thank you, Richa, for those words. Coming to you, Amit, let's look at the impact of this decision on the ground. So, what practical challenges does this decision pose for taxpayers? And can you suggest what steps should be considered to mitigate the potential risks?
Sure, yes. The way I look at it, the decision actually bring back the secondment arrangement back on the drawing board uh, with more sharper focus. Secondment arrangement is a global topic. It's not a very new topic, as Richa also mentioned. OECD also laid down quite a few things in that. The concept of economic employment, legal employment is well covered by multiple other jurisdiction and kind of quite a few other countries. But what the High Court, after relying on Centrica, reiterated that just you call reimbursement without any markup, that will also an FTS. It also mentioned about other overall facts like employment leave and continuity of social security, right to terminate secondment versus employment. These are important and critical factors before you decide whether it's a secondment arrangement or not, who is a real employment, etc. Now, if you look at it in practice, some of these expectations, what the judgment says, may not necessarily be addressed in a secondment arrangements. Particularly, there are labor law compliances, social security requirement, which is already there in other countries in the home country where secondis has to go with it. Now, what does it bring? It brings that you are back to the drawing board to recalibrate what is the real expectation of the authorities. Earlier, the conversation was more around supervision and control, the accountability of the employees, etc., etc. But those are no longer sufficient. The court talks about what are the new other areas which one needs to look at it, and therefore a recalibration of the thoughts are very, very important. The way I look at it from a practical challenge perspective. Other few aspect which it mentioned about service P, and I think so. The earlier speaker also mentioned about how the service P to be looked at it. Morgan Stanley in the similar scenario has mentioned service P, and if a service P comes, attribution comes. Richa also mentioned about transfer pricing comes. So, in an overall basis, if this decision had to be applied in the manner in which it is written, a recalibration of thoughts are required to look at it, how we are going to merge some of these aspects, and then kind of decide what is the way forward.
Right. No, thanks, Amit. In fact, you're absolutely right. Maybe the entire concept of secondment needs to be relooked if you go for the narrowest interpretation of this agreement. But just to add on another point, the India US DTA contains the make available test. So, how has the court analyzed this requirement? Any implication that taxpayers should be aware of and keep note of?
Now, that's a very interesting aspect which you have asked for it. The High Court, in the course of its analysis, with all due respect, have analyzed make available clauses, but to my mind, it has gone into slightly further in the factual aspect of it, saying that the secondis were brought into India to imbibe the culture of the taxpayer or the foreign entity and to implement policies and standard to the Indian entities. They were here for a certain period of time, which is a little longer period. And once the processes and policies are imbibed, there is no need for secondies to work in India, and Indian company will be able to do by themselves. Now, in practice, whether these are the right way of closing the aspect of make available or not, that's a point which one needs to look at it, and it is highly debatable. Therefore, while they touched on this subject, but they were not in a position to conclude it properly with all due respect. And the way the judgment articulates is that some of these aspects have not been challenged or properly analyzed by tribunal, and therefore they are accepting it that it is making available. And one more point, if you read this judgment in the fine print, there are two aspects of it. One was a secondment side of it, and one was direct services rendered by the foreign party to the Indian clients. Now, somewhere I believe there was an overlap in thought process. While training, another aspect of consulting, comes into the second side of it, where the foreign party is providing services to the Indian client. Secondment, the whole concept was that these deputies are the employees of the Indian entity. Therefore, the services what they provide is for the Indian entity. So somewhere I believe the courts have not gone through the finer difference between both of them, while they try to analyze the make available, but did not look at it in a holistic manner rather than a very, very specific matter there, and they try to conclude on that.
Great. Thanks a lot, Amit. Maybe you opened up more questions than it is answered there. So coming to you, Pramodji, again, to kind of, you had referred earlier to section 192 versus 195. And I thought we can maybe dwell upon it a little longer. The interplay of these two sections in secondment arrangements, could you explain that?
Thank you, Riaz. Section 192 talks about deduction of tax from the estimated income under the head salaries of the recipient of that income. So if there is an employee who is seconded by the foreign company, what will be taxable in his hands as his income, that is to be done. That is to be deducted tax from. Section 195 talks about income of the recipient, again, from the payment which you made, GE Technology, a whole lot of cases have clarified it. So in both these situations, they talk about income of the recipient. The trouble arises when income of the foreign company is sought to be taxed on the gross basis under 115A. Then you are not taxing the income, you actually end up taxing the payment. And if so, there's an overlapping. Same rupee which you give it to the employee, because there are old decisions of the mid-90s. We had a whole lot of decisions when question came up, what is the amount for which employee is taxable? Matter went up to Supreme Court. In Ali Lilly's case, they said, if all that the employee has done is they have rendered services to Indian, the recipient of service, then everything is taxable. So entire amount which you pay becomes taxable in the hand of the employee. And because you do it on the gross basis, so entire amount becomes taxable in the hands of the employer, the legal employer also. Now, if you think of the law as it evolved in mid-90s, when we were just seeing the first starting of legalization, when so much was not known about the taxes, about the salaries paid abroad. And we had a whole lot of decisions, Grindlay's Bank, British Airways, then there was Circular 685. Law is settled. If all that you pay the foreign company is for the services of the employee stationed in India, seconded in India, everything is taxable under the head salaries. So nothing survives for taxation in the hands of company. And I would think the way Boeing decision is given, and Boeing is given by the Delhi High Court once again against Boeing also, SLP is dismissed by the Honorable Supreme. And Boeing has been followed by Karnataka High Court on the same lines, that you cannot have the same rupee on which you deduct tax under section 192 and tax under section 195 also. That's simply unworkable, and that's how they've interpreted the scope of 195, because 192 deduction has already taken place. In this case also, Boeing was referred to, but there were more than one propositions emerging out of the Boeing. What the court did was they dealt with the other proposition which dealt with the economic aspects of this, but this proposition was left out. So I would not say that the Delhi High Court has done anything against that school of thought. Today, there is not one voice of dissent on the question, that on whatever you have deducted tax at under tax at source under section 192, you cannot deduct under 195 also. That principle remains intact. SLP dismissed. Karnataka High Court follows Delhi High Court, but Delhi High Court itself, when in a subsequent decision, somehow they fail to engage with this. So I think that issue is still open. There is no voice of dissent by any of the honorable courts. And I think we have to see how things evolve. And I'm also curious whether this matter will come up for a review or some other process before the court itself. Because you can't really tax one income and one imaginary income. And then again, it goes back to the question of you do it on the gross basis or tax basis. Because if everything that you have paid to the foreign company belongs to the employee, they cannot be an income of the foreign company. Whatever they received, they give it to the employee. So that's an interesting interplay. The jurisprudence so far is in favor of the taxpayer. And let's see how things evolve in times to come.
Thank you. No, I think there are lots of issues, and I think we can keep discussing this case. But given the interest of time, and after at least the right questions, the invigorating discussion that we've had so far, it has been very enriching. Let's move on to the next case, the Bangalore Tribunal decision in Pramod Kumar Jain versus DCID. Now here, taxation of employee stock options or ESOPs has traditionally been examined in the context of exercise of options and allotment of shares, where the difference between the fair market value of the shares and the exercise price is taxed as a perquisite under section 17(2)(6) of the Income Tax Act. However, a more nuanced question arises when the vested options are repurchased before the exercise. Does the consideration received by the employee retain the character of salary or perquisite, or does it represent consideration for transfer of a capital asset? So to start our discussions on this case, I would request Richa, could you provide us with a brief summary of the case?
Sure, yes. So if you look at the facts in this particular case, the taxpayer is an employee of Flipkart India, which is a step-down subsidiary of Flipkart Singapore. There is a stock option plan of Flipkart Singapore where the employee was granted certain stock options. Subsequently, the Flipkart Singapore offered to repurchase some of these vested options. The key point to note here is that the options were never exercised. They were only vested options. There were no shares which were allotted. So whatever consideration was received by the taxpayer from Flipkart Singapore, they declared it under the head capital gains. The company, on the other hand, they had deducted TDS under the section of salary. Now, the AO, they relied on Form 16 and they rejected the classification of this receipt as capital gain. The CIT upheld the addition. The matter then moved to the tribunal, where the key observations of the tribunal were that initially they analyzed the entire life cycle of a stock option, and they said that it runs through 5 stages, which is the issue, vesting, exercise, allotment, and then sale of shares. And in this particular case, only the first 2 stages have been completed. So what they then mentioned was that in this case, since it is only a vested option, there is no specified security which has come into being, and that is what is taxed under section 17(2) subsection 6. Now, it also said that the explanation, it gives valuation methodology only for a specified security, and since this security, the option is not a specified security, the computation provisions are failed. And there they relied on BC Srinivasa Shetty to say that the computation cannot move further. Then they also went on to say that Form 16 and TDS, if it is done by the employer, that's not determinative. Next slide, please. The tribunal then went on to hold that a vested stock option is actually a capital asset, and Repurchase of a vested option in that case becomes a transfer, which is chargeable to tax as capital gain. The consideration is hence not taxable as perquisite, as there was no specified security which had come into being, and the taxpayer had rightly offered the sum as long term capital gains. Over to you, Riaz.
Thank you very much, Richard. That really provides us with a great context to the case and the issues that it has raised. So let me move on to you now, Pramodji. Now, we've had 3 earlier decisions where the Delhi High Court, the Madras High Court, and the Karnataka High Court, which has dealt with the same ESOP scheme. Now, what do you think about this latest Bangalore Tribunal decision in Pramod Kumar Jain's case in the light of those decisions? Now, are ESOPs, the question here would be that are ESOPs intended to align employees with shareholders? If yes, then should the gains and losses on repurchase be taxed as capital gains rather than salary? Or does the fruit of employment argument carry more weight? Now, what is your take of these bunch of decisions and the underlying controversy of ESOP taxation?
Okay, thank you, Riaz. Now, this is one particular bunch of cases which has 2 different transactions involved. These are 4 cases. 3 cases deal with one kind of transaction, and the 4th case, which is the latest case, deals with the other kind of transaction. In first, and it's like a controlled experiment. You have one plan, you have one employer, one workforce, same facts, and you have 3 different outcomes. In Madras, the decision, that is the Honorable Madras High Court decision, is that it's fully taxable as perquisite. Honorable Delhi High Court, Honorable Karnataka High Court, they say it's a capital receipt, it's not taxable anyway. And now you have Bangalore decision by the tribunal, which says it is taxable as capital gains. But then what Honorable Bangalore tribunal deals with is materially different. Now we have to understand these 2 transactions. I said in first bunch of transactions, money is received, but every option is retained. Nothing is surrendered, nothing is cancelled, holding remains intact before and after, and you get an additional amount. In the case before the Bangalore tribunal, you have received the money, options are actually bought back, and the prices are extinguished. So 2 different transactions, 3 different outcomes. But to understand, and as per your basic question when you asked about the alignment, yes, for the corporate purpose, the plan says so in the object clause, but then you have to understand to what extent you will take that in the tax characterization. The first issue which arises is the some kind of a conflation, because when we talk of the capital asset and capital receipt, these are 2 different things. There can be situations when you have a capital asset, but which is a revenue receipt. Take, for example, you are working for, let's say, a taxpayer who is dealing in real estate or anything else of substantial value, and you get something as a part of employment, which is capital asset in the nature. So, will it get out of the taxability for this reason alone? I don't think so that really happens. The employer, for example, gifting a house, will that fall in the category of being outside tax ambit of taxation because it's a capital asset? That's a proposition which is difficult to defend. So the revenue argument would probably be, look, you received it as a fruit of employment, and therefore it's taxable in nature. That's how the law is all over the decades. If something is received in consideration for your having rendered services, it is generally taxable in nature. And the definition of income is the widest definition you can have. So anything which is in the nature of income is income. Question is under which head it is to be taxed. These are 2 different questions. And remember, there are a whole lot of decisions from Emil Weber onwards when they said even if you receive something which is a fruit of employment, but for a person other than employer, then it becomes your income, but it becomes your income under the head income from other sources nevertheless. Similarly, you have the decision in the case of Justice Devkinandan Agrawal, where they said, I have no employer. One of the arguments of the honorable judges was that, look, judges cannot be said to be employees of government of India, then how it can be salary income? but they said it's a fruit of employment nevertheless. The difficulty which really arises is, and you have, that is because of the timing at which it is to be taxed. And in the old cases of Abbott versus Philbin, House of Lords cases, where they said emolument you get in the option is a grant, it's taxable. The difficulty which arises is when by an amendment in law or by a statutory definition, you decide its timing. You say, all right, you may have received options today, but it will be brought to tax at the point of time when, let's say, it's monetized. When you sell it, you exercise it, or something which comes closer to that. So the statute prescribes various points of time when an income or, let's say, gain by way of ESOP could be brought to tax. But that visualization does not include situations like the situations that we are dealing with. Situation in which you get an additional compensation for loss in value of that share, which happened in case of Flipkart because they sold PhonePe and they said now the value has come down. So we'll give you an additional compensation of $43 and some cents per share. In that was a situation which was not defined, visualized by the mechanism which was to decide the point of time when it is to be taxable. Similarly, the case which we are dealing with in the case of Bangalore, where the option itself is being bought back. That is not visualized as to what point of time it is to be taxed. So one reason why this is not taxable to my mind is simple. Under the law, you have said that no, it will not be taxed at the point of time when you receive it. It will be taxed at some other point of time, which will be defined by the statute. That point of time definition does not cover these transactions. So I would think one way of looking at this is that it is not for the judges to give casus omissus. If there's an omission in law, they cannot supplement it. If mechanism or timing is not decided, they cannot supplement it either. So for this reason, it is not taxable. Of course, the other view could be that from the point of view of pragmatism and a reasonable interpretation, when you receive the money in lieu of these things, then at least it should be brought to tax. Because the scheme of changing the point of time of taxation is not to give exemption, it is to give a deferral. And deferral's outer limit will be the point of time when it is monetized, when it is converted into dollars and rupees. So if you look at these decisions from the point of view of what is the basis on which the decisions have been given, then except for Bangalore decision, I think both the other stream of decision would probably admit other arguments as well. As far as Bangalore is concerned, their point is, when you gave me these rights, you did not tax them. Now these are my capital assets. And what is being brought to tax is the accretion in the value because of my holding it. So it can only be capital gain. To me, on the first principles, it makes a lot of sense. But when I think of the Delhi High Court judgment and Karnataka High Court judgment on one hand, and Madras High Court judgment on the other, I would think of the reasoning which they have given, the reasons, the decision, they admit other arguments also. For example, Honorable Madras High Court wants to take it to perquisite. It is not perquisite. If that point of time is not defined, then how can you take it how can you stretch perquisite definition to accommodate this? The mechanism is incorrect. But nevertheless, argument could be, it is monetized, we can't wait any further. But then you are not policy maker. If somebody has to interpret the law, then it is possible to say that no, that point of time is not defined, so it can't be brought to tax. Now, what is the solution? To my mind, if the law had one sentence added to all this mechanism, and the sentence was something like that, in any case, it will not be the point of time beyond which it is converted into money or money's worth, then everything comes to an end. So probably it's a parliamentary gap, but which justifies non-taxation of these amounts. But the line of reasoning which is adopted in these decisions, particularly the three decisions of Honorable High Court, one of which is by a division bench, two are by the single judge judgments, and both these decisions are in appeal, I'm told. So those decisions admit other arguments as well, and most important argument would be it's a fruit of employment. So if it's a fruit of employment, why not tax it? And if you say that it is given gratis For example, in Delhi High Court judgment, there is a mention about the fact that it is given without constellation. If it is given without constellation, what for do you have section 56 to 10? So those are the areas one will have to see how law evolves. But on first principles, yes, because of
Thank you.
not defining, there is a case. Thank you.
Thank you very much, Pramodji. And of course, capital gains will also give rise to various issues of jurisdiction of taxation when there are when there's mobility of employees. But those are various other cases, issues which can arise, which could be discussed on a wider forum. But on this, Amit, coming to you, do you think that the absence of a clear computation methodology strengthens the argument that Parliament never intended that these receipts should be taxed under Section 1726?
No, answer for that is very tricky, Riaz. As Pramodji mentioned, is what is there in hand? There is a process status which is given, the way the entire ESOP is going to be taxed. The first point when the taxation being slated is when it is shares are allotted, which is the third or fourth stage of the entire thing. The valuation rules also talks about the valuation as on that day. Therefore, any event which is happening prior to that day, valuation is not there in the regulation. Perquisite cannot tax anything which is deemed not written there itself. So therefore, the way like Pramodji also mentioned, the first principle says that, okay, fine, it is not taxable as perquisite. 1726 talks about the specified security. The specified security only get a birth once the shares are allotted or the employee shares have been handed over to the employees. And therefore, the court mentioning and referring about V.C. Srinivasa Reddy and saying that charging section and computation mechanism together constitute the integrated code. And in case the computation provisions are not there, the charging section cannot also be applied. To that extent, one can say that that particular argument which court has taken possibly is correct, while it was not been envisaged when Parliament was making this particular law. So I think so. I would love to see how the courts are going to look at it, particularly in line with the other provisions of Section 17, which is profit in lieu of salary or any other benefits as a part of perquisite, because eventually it is nothing but fruit for employment. And therefore, one can always take an argument that it is going to be taxable under Section 17 as salary itself.
Thank you for those comments, Amit. Coming to you, Richa, what should taxpayers do with this sort of ambiguity? What is it that the government can do to give clarity on the issue? Because I think this is going to raise a lot of uncertainty in the minds of the taxpayer.
So I think first and foremost, it's very important that taxpayers are aware of what sort of decisions are coming and they actually track them. We have, as Sir mentioned, salary taxation, perquisite taxation, capital receipts, all sorts of verdicts coming in. So what is important that you need to see what exactly is the type of encashment that is happening in your case. Is it compensation for diminution of the value of the exercised option, unexercised option, which may not even be an asset? Then there's cancellation, repurchase, and then track it how this is the judiciary or the judicial view is evolving. Very conservative view, and which may find favor with a lot of with the department and the government also, is that all said and done, it is a fruit for employment. Even if a payout is being done to you on a cancellation, it is only being done because they want to retain you as an employer, so dehors of whether it is done after you exercise the option or they do it at an earlier point of time to take care of the diminution of value. The essence is that it is related to your employment. The nexus is with the employment. And even when not exercised, the payment is only to retain the employee. So I believe that would be the safest proposition. But however, we've seen that there is so much of a dispute around it and ambiguity around it. And on the economic side of things, look at the rate difference. It's 12.5%. to 30%. So the taxpayers can make a conscious call, knowing very well that if it is taken as a capital receipt or a capital gain, there is likely to be litigation. So you need to track that. And of course, from the government's perspective, I think very clearly there is an ambiguity which needs to be addressed till it turns up into something again of massive litigation on these type of arrangements. So one, all these scenarios that we see happening today, clear guidelines on how these should be taxed, salary, capital gains or capital receipts, how the valuation needs to be done, and if they say that this is a capital asset, how the holding period is to be determined from the date of vesting, from the date of grant. All those things they need to take into account. So this, I believe, can surely help nip the litigation that is likely to brew up on this issue. And we are seeing these three of these decisions around this issue. I think that may be a very opportune time right now to put in some guidance in place.
No, thank you, Richa. But interestingly, you mentioned about holding period, capital asset, etc. But you also mentioned whether it can be treated as a capital receipt. Any views on that? Whether this can be treated as a capital receipt completely out of tax? Either you or Pramodji, anybody who would like to respond to that?
So two of our decisions are talking in that tune. Maybe Pramodji can also throw some more light on it. So that's an interesting proposition.
My apprehension is that number one, it's a perfect recipe for a retrospective amendment, with the realization of money being the outer limit to which it can be deferred. Number two, in case we go by the judicial principles, it's a fit case where you cannot bring it to tax because you did not define the point of time when it is to be brought to tax. So if I think as a judge, if I was to be in a judicial chair, I would have said you have not defined the point of time when it is to be brought to tax, so you can be helped. But if I'm a policy maker, I would say, so what if I have not defined so far? I'll define it today and I'll define it with retrospective effect.
Great, that's interesting. Okay, I think we are on time. So thank you, all the panelists, for an extremely engaging discussion. And I think both these topics have so many issues. We could go on for another hour of discussion, but given the limitation of time, we have to end here. Thank you to all the participants for devoting your time for this conversation. And if you have posted any questions on the chat, we'll get back to you with our responses very soon. Thank you very much.
Thank you.